so welcome everybody. We're going to get started. Sorry, we're a couple of minutes late. We were scrambling getting things going, so we are here. We will go through the intro fairly quick so that we have plenty of time to talk about everything. But again, we appreciate you being here. We know you have a choice on what to do and where to be, and we hope that we always bring you value every Wednesday night. So disclaimer, this is an educational series. We are sharing what we believe to be true, what we believe to be the best facts based on our experience. We are not lawyers, accountants, financial advisors, but we have definitely been highly involved in real estate investing. And so we are here to help you learn what we have learned. So quick reality check. Let's get this straight. We're paying taxes on our wages. Then we're paying sales tax to spend that money. Then we're paying income tax on the money that was already taxed. Then once we die, our kids will pay a death tax on money that was already taxed. Think about that. That is pretty powerful. So it really is. So let's flip the coin. You don't pay income tax if you don't have income. So we talk a lot about the power of real estate and all of the tax advantages of investing. So again, it's not how much you make, it's how much you keep.
Full disclaimer, someone asked me what does income mean? It is taxable income, not the income. You have income, it's just taxable income, FYI, right? Yeah. Thank you, Trevor.
All right, so we're going to talk a little bit about massive capital. Massive capital's value add to investors and partners. Tonight's topic is capital call. Unfortunately, it's become a much bigger topic than we ever dreamed it would become. So we want to talk to you about what we feel is happening, different things that we're thinking and doing, and suggest that you do.
And Trevor, don't get mad at me, buddy. I forgot to change the total number. I didn't get a time. So it's 203 million. I calculated it.
So, all right. So Massive Capital is a vertically integrated real estate company specialized in ground up construction, retail, flex space, industrial, self-storage, and mixed-use multifamily. Massive Capital is an owner-operated value-add multifamily, and we have 42 years combined. So we're the 2, Realty One is the 40. So we've got a lot of growing up to do. But if you look at all the team members, we've got a lot of years of experience in real estate. On the left-hand side, we're involved in equity, brokerage. On the triple net side, for those of you that don't understand, that has to do with retail, where it is triple net. Also, we're in property management on triple net. We do development, construction, both metal and wood. So there's a big diversity of what we do. And then, of course, we have our education mastermind program. You'll see from the map, we are definitely heavy Texas focused, but we do have assets in Denver, Colorado. We have assets in North Carolina, Atlanta, Georgia, and Tampa and Phoenix are on there because we've made offers on a few triple net retail new build, but we have not been looking in those markets very heavily for anything in the multifamily space. So if you look at Realty One, they have a total of $290 million assets under management, about 500,000 square feet of retail, and about 250,000 square feet of retail center. It's a little bit different. Massive Capital itself, we didn't update the slide yet, but we have over 1,500 units and 203 million under assets. We're so busy buying and opening assets that we don't have time to update our slide, but we closed on the Horizon property, which is pretty exciting for us. So this is the team behind the team. So you'll see a lot of people here. Some of them you'll deal with on a very regular basis, especially the top row. And then as you get down further, we get into our finance department, our accounting department, and then all at the bottom, we have everything to do on the Realty One side with brokerage, leasing, construction. So the team itself is getting to be quite large. We're very excited. We're very excited of a few new hires that are going to get put on here very soon. So we keep growing because we have to be massive. That's what we have to do.
We have massive workload, right? So we have 4 new hires joining, hopefully in the next 2 weeks. And so we're really excited.
Yeah, so the team, the partners, so we have Shirar, who's with me tonight. Mike, who's living it up large with Sanjay in Beverly Hills. They're both over there at the realty or at the, sorry, at the family office. So I'll get that right. And then we have Bo, Pat, and Alexis. They're the principals from the Realty One side. So we're super excited to be partnering with them. So a little bit last year in 23 and 22, we closed 15 properties. Pretty good in today's environment for us to be able to close on the properties. We have a new construction in Houston. We have LOIs pending in Dallas, San Antonio, and Houston. We did close, as I mentioned earlier, on our Horizon property, but we still are raising capital for that property. So some people may say, well, how do you do that? Okay, well, you need a certain amount of money to close, and then you need the balance of the money to implement your business plan. We have enough to close and to start the business plan. We need the rest of the capital to finish the business plan so that we can go ahead and do it. We've been very successful in the last week. We're expecting to be full in the next week, so don't miss out on this great opportunity. It's an amazing property. A little bit later, we're actually doing a tour there next week if somebody wants to, in San Antonio area and just wants to come and see and learn. And it is a 506C opportunity for accredited investors.
Trevor, thank you. And tomorrow, all the three partners will be in San Antonio. We're meeting a large investors who like the property, underwrote it, and they're ready to cut a little over $2 million check. And we're meeting with them tomorrow. So thank you for all the work, Trevor.
Yeah. So Harris Ridge, we were bragging that we closed, and we had closed, and we thought we'd closed. One of the things you cannot do is count your chickens until they hatch. So we had a 1031. They were very new. There was a lot of complications on their side that they just didn't understand. So at the last minute, they decided that they wanted to use their funds somewhere else. And so we do have an opening for a couple of spots on our Harris Ridge. It's an amazing investment opportunity. It's located 12 minutes from my house here in Austin, Texas. And we do have, if you're a large investor of more than 250,000, please book a call direct with me. I'll put my contact info. We do have a bonus offer. We expect this one also to be closed this week. We have about 3 or 4 folks that between the 2 of them can get it closed completely. So we're super excited. It's a great place if you have a retirement fund investment.
Trevor, on that note, I think I was running late. I ran late for this call because I had an investor that you sent the email. The gentleman is excited, and I think he's going to fill out almost a good chunk of the gap. For learning, I just wanted to share that not all 1031s are made the same. Chances are everybody here has done 1031, but not 1031 in a syndication. The structure is different, legal paperwork is different. So we had a learning from us, for us as well. So now for any syndication, if someone wants to do 1031, we do an onboarding call or like a pre-call before the agreement kicks in, and we are walking them through what does it take to do a 1031 within a syndication and make sure that both parties are aligned. Then we execute the work. That's because execution of the work, it's a lot of legal work, a lot of restructuring, and it adds a lot of timeline to it. So learning, just keep in mind, 1031 doing a 1031 to buy a house, it's not same as doing a 1031 to buy an apartment. It's different. So thank you, Trevor.
Yeah, so we're super excited. So for those of you that don't know why Facebook broke the other day, it's Mark Zuckerberg sending you a message. If you don't invest with massive capital, I'm going to shut it down again. I thought that was just too hilarious not to make a graphic on. So I got to tell you, we all panicked when they went away. So we definitely did. And then I'm not sure, I did do an event slide, but I don't know if it ended up saving because
okay.
If not, it's fine.
You want to talk through it?
Yeah, so I'm going to put a link here in the chat. Maybe if you just want to open up the chat real quick and just share it if you can open it. Depends if you want to do it that way. I just wanted to tell you about a few events that are coming up to make sure that everyone, if not, it's okay.
Okay. Just explain, then we can drop
Yeah,
the chat.
so just to let everybody know, this Friday, we're going to be visiting 2 of our properties in Dallas, Texas. And these are just property tours. They're open for existing potential, or just people that want to learn. So we're doing one property tour in Fort Worth, another one in Dallas on Friday. Then our ladies are at the Conscientious at the Investor Conference speaking. So Jasmine's there speaking. We're super excited that. Then on Sunday, our ladies have a lot of fun. They're having breakfast after an event there. And then on Tuesday afternoon, 2:30 to 3:30, oh no, 3 to 4, sorry, we have a tour of Horizon Apartments in San Antonio. So again, if you would like to attend any of those events, it is just a learning experience for you to see exactly what we're doing.
Trevor, thank you for coordinating that. The way we set it up, we have one 400 plus units and one and less than 100 units, and you will get a difference in the look and the feel and a B and a C and pre-capex, post-capex, and how we differentiate, how to position a property once you finish the capex. So it'd be a good one for if you have half a day. Come join us. We'll send you the link so you get to see the both side of the coin as well. And we find it very interesting, very educational, and you'll find it interesting and educational as well, because underwriting is great, talking is fantastic, but when you see it and how you put the whole project together, it's really awesome and gets you a better realization how to underwrite it.
Yeah, and it's we always really enjoyed it. It's a great time for you just to get that practical experience. So Massive Capital, we grow together. So landowners, we're interested in joint venturing. If you have A-class property location, so we're not interested in the middle of nowhere. We're looking for urban fill properties for us to do joint ventures to build. If you have assets under construction and you need some assistance, reach out to us. We'd be happy to see where we could help. On multifamily, we do asset management. We can do CapEx and credit enhancement. So a lot of our deals that we do on the partnerships like Denver, North Carolina, we offer the credit enhancement, and we also raised a little bit of the capital just to help them close the deal. And then we do consulting. So we have an awesome CRM system that we're going to do one day a full-blown presentation on because it's pretty amazing. And then we're written our own back-end asset management tool that we think is going to be very exciting for people to be able to use. We've been using it for our own purposes and think it's too good not to share.
Well, just to add the asset management software that we have, I was talking to a larger operator. They have over like 8,000 units. And I gave them a little glimpse. It was like, hey, why don't you come and do it for us? And we need some help with it, right? So it's really interesting, the small software that we have. And now it's a full-blown IT project to create our own data lake so we can really standardize that for all of our partners as well. So in other way, if we partner with someone, all of our co-sponsors, they have the access of the data that we have. And this software sits on top of all the property management companies. And it enables all the asset managers to understand the asset without talking to property management companies right away. So makes you more independent as you go.
It's awesome. Okay. And also for those of you that are new, I think I've been posting my chats to the meeting room. So maybe that's why some people haven't seen it. Sorry about that. All of our recordings get uploaded on our YouTube channel. I shared it there. I'm also going to be launching a poll here. Our poll helps us determine what type of topics to give and who's involved. So we ask that you do us a favor and answer the polls, please. So capital calls, raise your hand if you've had a couple. Unfortunately, I'm in that boat. And so it's a really timely topic for us to talk about. I'm going to turn it over to Sherrar.
Trevor, thank you. So before we go, just to let you know, on YouTube, we have over 100 webinars. So if you want to get, see at least some of the topics we talked about, please go and what they call it, subscribe and like them as it kind of goes. Again, we are practicing to get better, but we post all of our webinars. It takes about 3-4 days for us to do it. So, this webinar will be posted in the YouTube channel as well. Okay, so back to the topic. What we want to talk about, the capital call, what is it and what to do. Before we get into it, just think about any project that we do, we have two kinds of risk, market risk and the project risk, right? Market is market, right? And a project is project. We could buy a house and I could buy a insurance for my home and that's mitigated. Or I have a house that is nowhere close to the floodplain on top of the mountain. But if a thunder strikes, it strikes. There's nothing even I can do about it. So from that sense, the way market made almost all of us money from during the COVID time, same way market took it out, depending on where we at. So independent to the quality of the project, independent to the quality of the sponsorship team, market took some of the money out. So that puts a stress on it. So objective for next session is give you an idea so you can separate that out. And we'll run through an example of how the dilution happens. And then we'll introduce some of the thoughts that what you can use to separate out a project versus the sponsorship. So when we are in a position we have to make a choice, we are making a very intentional decision as we kind of go through instead of getting emotional about it, right? So our goal again, take the emotion out, put that on the side for us again, look at objectively, a little more academically, put an equation and decide or make our decision based on that. All right, so capital call. So on a regular terms, and a capital call refers to the process or event when a general partner or a sponsor team will request additional capital from the limited partners who already have committed to the fund previously, right? So that's what we call a capital call. If you go backwards as an engineer, I like the naming convention left to right. It's the name right to left tells you what it does. So it's a call for capital. That's the capital call, right? And how it happens, right? Typically it happens, the market driven, right? Market changed, insurance changed, taxation changed, interest rate changed, right? So just imagine 2 years ago, we're buying properties in Houston area. Yes, we baked in, 15, 10%, increase in year one, maybe 8 or 9% in year two, but we did not bake in any kind of a cost at a 50% increase or not 50, 150% increase, 170% increase, right? So that's one. And if we think about that in Florida, they went through a tremendous amount of insurance increase. They have another one coming up. That is not controlled by us. Just imagine we're buying something. If I buy something on a pro forma and I'm underwriting with 2x the insurance, everybody will put us in the crazy bucket, right? Versus when you underwrite it. So this is something we try to mitigate, but it's tough. Same for the taxation. It's a market driven. There's nothing we can do about it. All we can do make better prediction about it, right? Because again, we're buying the assets on a pro forma. Whole idea is that how strongly we can forecast and how closely we can come. Last one is the interest rate. This is like somewhere between choice and a market, right? So, but when all of those happen and maybe happen at the same time, that's the worst part. If that happens one after another one, we have time for assets to kind of go back and run and recoup. Then if just the insurance increase, it's fine. We bumped up the rent. Our NOI would not go up, but insurance cost will be recouped. Then tax shows up afterwards, no big deal. We'll do the same thing. Project is still going to move on. But when all three stacks at the same time, and you don't have much of a time, that's very detrimental, right? So that's the market driven, and that's what most of the time happened. Last year, a year and a half, insurance and tax caught up. Everybody has mitigated. Most of us, we have mitigated. Now the interest rate that is showing up now, that's going to drive most of the decisions this year. The other one is the operator driven, which is within the project that we have, how a sponsor team is making decisions, right? Which is us as a business team, that what is our strategy? Did the team know about the market cycle and put the right financial structure, vice versa, right? And on the assumption on the pro forma, did we make a crazy assumption or not? I mean, crazy now, hindsight 2020, 2 years ago, buying on a rent increase, 5%, 7%, 8% was no big deal. We have seen double digits, but some of the folks I have seen 15, 20% increase, right? Question is how wide was the assumption in pro forma? And the last one is the capability and capacity. Look, life is life. We got to call it is what it is. Sometimes we go over our head, and sometimes the team is out of the capacity line. They just don't have, they're tapped out. And at the same time could be the capability, right? Just because I bought a 10 units and I flipped it, made money, it does not mean that I can buy 100 units. It doesn't. A CEO of a $2 million company is not the same as CEO of a $20 million company. It's just you need different kind of thought process, different kind of operations. It's not quite linear, it's asymmetrical. So look at it that way as well. And the last one is the operations driven. So market, the macro, that's like a semi-micro, and this is really micro.
And now, here's someone you want to hear from, our sponsor.
For over 15 years, Skyline Title has been a trusted name in Texas real estate. From first-time homebuyers to seasoned investors, our team ensures a smooth, reliable closing experience every time. Backed by a decade of partnerships and proven success, we take pride in protecting your biggest investment, your home. Visit SkylineHTX.com to learn more.
Like what happens? And if you think about the capability and the capacity, number 3, then you go into the operations, it will make more sense. That does the GP team know how to hire the property management company? Or did we hire the right property management company for the right asset class? And did they have enough local know-how? And the phasing of execution that, did my business plan call for pump and dump? I have to finish all of my CapEx at the same time. I have to turn all of my, units at the same time, or churn the tenants at the same time. So that is also one of the major reasons we saw capital call happen. My example, we bought extremely value add, which is 70% occupied, 50% paying customers. What does it tell us? We got to come in and do a heavy CapEx and evict almost everybody, and then bring new set of people who are paying. And then you got caught in the insurance, interest, and tax. So you are juggling through, and the operator could be best, right? They have good tactic, makes sense. Performer is not wild. They have the capability and the capacity, but they got caught in the phasing of the execution and this one, right? So that's one of the way, if you take a look at it. So the whole idea is the quality of the project multiplied with quality of the sponsor team. That will equate to a probability of success. So it's a blended equation. We like equations. All right. On that note, as we go through, if you guys, whenever you all have questions, please drop it on the chat. After that, we'll come back and answer as much as we can, and then we'll kind of go from there. So just keep in mind, if you're an LP, look at the sponsor team and look at the quality of the project. And the way you look at the quality of the project is going back in, what is the assumption look like, right? And what's my revenue assumption, what's my cost assumption, and what is my CapEx assumption? I'll give you a little bit more a little bit of clarity on how we think about it. Given where we at, the revenue increase will happen 2 ways: market and by value add via operations, which is rehab. We're seeing the rehab a little bit, but we're not seeing the market, at least for this year. Next year, we're expecting, market's going to bring back quite a bit of rent increase. And also on the sponsor team, you asked the questions, what happens if the asset manager goes on a vacation for 6 months? Send them to Hawaii. Who's going to manage the project? What is my office looks like? Who's running the CapEx? What happens if the one-man show, if it's the two-man show, if it's a team, right? The bigger the asset under management, more the back end is to happen. And that has been a recipe of disaster for almost all the sponsor team, especially the big ones who ran too lean, right? And then when time came, they had to deploy the human capital and get a hold of the assets. Most of them failed, right? And that's one of the things we said, it's just the quality of the sponsors team. It's look at the structure of the organization, right? It's cool to say I own or I run 50 million, 100 million, but then you reframe the question, is that okay? Somebody is the CEO or COO of a $50 million company. We don't hire a part-time CEO to run a $50 million company, right? We always have full-time. And how does the team look like, right? All right. So let's go to an example of capital call. So the case study, what happens after capital call, right? So we'll go back and recoup again this bottom section. But for now, let's assume all of us were in a capital call. And we are going to know what happens if we do support or we don't support, right? So the base example is this is a project that we all have participated. We have 4 investors, 4 JV partners per se. Everybody pitched in 25%. It's a $400,000 of capital was needed. 100% of the ownership split between 4 ways, right? And now, so the 10% capital call happened. For whatever reason happened, and we need to, the project needs about $40,000 of capital injection, right? So everybody participated, 10, 10, 10. So what happened is that 25% was valued at $100,000 before. Now it's $110,000. So you have the same equity share and your cost of holding went up. So your cost of buying that equity went up. So end of the day, instead of a $400,000 of total capital contribution, the project was around 440, but the ownership stayed the same. Again, first scenario, fully funded capital call, 4 people, we did it, everybody participated, and we kind of go through it. And I'll show you I'll share a real time or real life example as you kind of go through. All right, second scenario, partially funded. Let's see, I chose to do it, Trevor chose not to do it, right? So what happens? Again, we have 4 partners. Trevor, I'm just using your name for a second. So investor A did not participate, so the capital is the same. Investor B decided to participate here, and then it's become 110. So what happened? We have 400 initially going in. We raised $20,000 additional. So my existing is 420, and the investor A lost a percentage, went to investor B. Investor C lost a percentage, went to investor D. Right? It's there. Now, scenario 1 is fully funded. Everybody participated. Scenario 2 is partially funded. Now, what happens that we must have the 440 grand? There's a gap of $20,000, right? So again, we kind of taking the ownership and we're sharing between the groups. So we're redistributing the 100% from 1/4 equal to 24, 26, 24, 26. But guess what? We still have a gap. Let's look at a gap. So it was a failed capital call, which is nobody did anything. And I want to make the scenario clean, and we bought in a new offering. So we have someone came in, investor E, on the sideline. They liked the project. They thought upside was there, and they thought that capital injection will fund the project right with the right team is going to move forward. So total contribution went from 400 to 440, and then that was weighted distribution, so distribution by the capital from all the partners. So everybody here, it was 25, went down to 23, and then everybody's one stacked up to this one. So it's a ownership redistribution weighted by the total amount of capital was injected. And as the capital call happens, we take a dilution down. If you think about it, it's 2 ways. Dilution is a bad word, but think about stock buyback. If you really like the project, I bought a stock for $100,000, and I'm buying the same stock for $90,000. That's how I like to think about it. It's a stock buyback in a sense. If you have the opportunity, you like the deal, and you like the sponsor team, and you understand how the project got to where they got to, and you believe the project has a very good path to come back, that's where the investor E will come in and do it. And if you're in a capital call where you see another fund coming in and negotiating down or negotiating a place for them, and this is where they typically come in, where the existing LPs work their way down, and that allocation goes back to investor and E, project gets funded. That's what it is. And that's the simplest example that we could identify, which is what happens when when a capital call happens. In general, we'll dilute down, and then the new investors will come in. Caveat is when existing investors come in, they tend to be a lower cost because the project, you're intimate to it, you see what they're doing, you see what sponsors are doing, you like it, then you're gonna go do it. Assuming it's just gone, right? I don't no one wants to participate. The when the investor E comes in, they're gonna come back and say, hey, my 9% is a standard cut. I'm taking the risk just like anybody else. But guess what? I'm saving the ship to get to the very last leg of it. I would like a little bit more because I'm the plug. Then they will go back and negotiate and settle on a number. But based on that, we'll see how it goes, right? So that's the concept. And ask us any questions while we go, and then what I would say how we take a look at it on the capital call size, right? So for us, can we avoid capital call? Market is market, and we tend to think we make good, right decisions at that point in time when we have the project and based on the information that we have. So for us, it's a market cycle first, financing second, and project third. right? Cycle and the financing kind of goes together. People who come from a structured finance, you will know the way with structured finance on an ups and an up cycle will be different than a down cycle. On an up cycle, typically you do less leverage, more equity, so you have breathing room. Your debt overhang is low. But if you whenever come to down cycle, you want to lever it up as much as you can, even the market doesn't and banks don't want to give it to you. But in today's market, if somebody gives you 90% levered, you take it, because how bad it's going to go from here versus a year and a half ago, you're on top of the cycle. So for our position is we don't know where the market's going to go. I'll be wrong most of the time, but at least we know what phase of the cycle we're in. That should help us putting a decent financing and the project. It helped us quite a bit. We have done a lot of sub $10 million deals in the last 2 years. You guys know that's also because of the financing and the market cycle. That's that. And also we buy asset across the asset class and asset categories with geographical diversification, because it's investment. Nothing is riskless. Everything has inherent risk associated with it. And we're going to make choices, and hopefully most of them will be right. Some of them will be wrong, but we need to make sure our investments are distributed. So if one goes bad, I have 9 other 2 and complement that, and we'll be okay with it. So as an LP, we say the same thing. To keep on investing, smaller tranches, build your portfolio based on the time, based on the location and asset categories. So you'll have a good flexible portfolio. And if you're a sponsor, hey, enhance your business strategy. Or if you want to be a sponsor, if you go in with the mindset, I want to buy one type of asset class in a particular location with a particular brick size in a given day of the week, good luck, right? And operations philosophy is that we don't do any deal collectively as a team where we did not own any asset at least a year, if not 2 years. That's because it takes about 2 cycles to really get to know a local subculture. We're in 24 months, we'll have busted roof, busted pipe, we'll have 2 tax increases, 2 insurance increases, and a bunch of people and the culture that gives us a good understanding of the local thing. So for us, definition of local is not where you live. Definition local is you owned something with a similar size for 24 months. 1 year is okay, but 2 years is our comfort zone. And so far, that's how we kind of checked out for all the assets that we bought, that our team collectively owned asset at least for 2 cycles. We use third-party management company at a retail price. We are clear, multifamily is a revenue game. It's not a cost-perfect game. Cost is cost. There's nothing we can do about it. 50-60% of our cost controlled by the feds, right, or the state government. So we always say, pay the third party. If Billy doesn't work, call John. John doesn't work, call Mo. But if I have a special price with Billy and that is my business plan, I'll lose my flexibility, right? So again, and for us, we don't get into any special type of project unless we're very comfortable and we have a technical skill. Office conversion, we haven't done it. We don't want to do it. Certain skill set, and we go. Hotel conversion, from our perspective, it's a very niche product. It doesn't work everywhere. So somebody got to be in that business all the time. So we kind of stay shy and we kind of go. And then we also manage our asset with local asset managed partners. So we always have a local manager up until now to manage the assets. The liquidity of balance sheet philosophy, for us, we need to have at least 2x, if not 3x of the balance sheet. Because if you buy a $20 million deal, if the team barely has 20 million, that's a proxy of the liquidity of the team. So we're trying to do about 40 million or so. 3x on a smaller deal, but 2x is on a larger deal. That is a proxy of how much of a liquidity that the GP team has, because market is market, things go sideways, and sometimes we have to get 100, 200 grand right away to the project for a short time. And if the GP team cannot handle that much, it's problematic. Then you have to go do a capital call, right? And so that's how we structure, at least we mitigate some of the capital calls. And the question is, what happens, right? Yes, I'll give you my example, and I'll volunteer. Then Trevor, you may come in. We have an asset that we own, and based on the circumstances, do we need money to inject into the project, 200, 300, 400 grand for the last 2 years that we owned? Yes, we did. And how did we do it? We just called the GP team. We have our GP team. I said, hey, team, we need up a couple $100 grand. Who's going to pitch in for what amount, right? In our OP agreement, we have a very low interest rate amount. So our job is to float the deal as you go through. So we'll come up with the money in our own pocket, because we know if we bring the money today, 90 days from now, we'll get the money back. We don't have to do any capital call. moves on, right? So that's sometime will happen, and it is perfect to ask the GP team, okay, if the project goes sideways, you need $250,000, who has it, right? Depending on the deal size. If it's a smaller one, everybody should be okay. So that's how we do it. Did I do an LP from our team? We have done quite a bit of LPs. That needs a capital call. I think, Trevor, you could talk about some of the deals you choose to support or you did not choose to support. Then we kind of go from there.
Yeah, so it's very different. And one thing too, that not every capital call is the same reason or the same terms. So for example, I'm on a capital call and everybody who participates in the capital call was able to get a bumped up in preference. So this was a deal that had a 7 pref. They offered a 12 pref to all new money. So in theory, if you didn't go in, not only were you diluted, you were behind another prep, which was very interesting. Also, too, just some of the economic reasons for capital call. I was an investor on a deal that is going fabulously. They bought it from a developer, so they got it on a bridge loan at 80% loan to value. They went from 80% to 94 occupied. The value of the property went from 40 million to 56 million. But when they went to do a refi, they ended up having to get a HUD loan at 6.25% with a 62% LTV. So it became a cash in refi versus a cash out. So it's not like everything is bad. It's that, hey, the world changed. And instead of a cash out refi, we're in a cash in because they were hoping to get 70, 75% LTV and they just couldn't. And so even though that's a tough thing to get a cash call on that, it's not like the deal is losing. Now, I had another property. I made the choice to put in a cash call, and it only took them 4 months after the cash call to go to foreclosure. Really felt silly, good money, after bad, but it at the time we were going to go in foreclosure regardless. So I knew we were if we didn't, and sadly we still did.
On that note, if you're an investor or that, you should expect that conversation to happen long time ago, right? One of our projects, I was talking about it. There may be a scenario of $200,000 and a grand of cash in refi coming up in September, October. We talked about that. We started talking about it or running different scenarios last year. December, we talked about it. We gave investors an update what's going on. We gave an update, I think, a couple of weeks ago, what's going on, our plans, our tactics. So we are framing all those options that we have that we are going to execute, and then a probabilistic view, what's going to happen once we successfully execute some of the options and some of the sensitivity. So all of us, we are collectively working together towards the solution, right? And so point is, you got to make a choice, and also a good sign of a good team is that you are seeing that coming up miles ahead. One of our good friend here from Houston, he let a property go. I think he has done over 20 some odd deals. He made money almost all of them except this one. And that was a very tactical choice. I'll let the property go because the quality of the project has turned so fast, so quick, it didn't make sense. His investors still invest with him because he made them money and he's a good player and he's going to make the money back again, right? But you just take a one hit in there. So going back, you got to see if that's something were to happen, you should hear about it, you should talk about it. Or if you're an LP, the sponsor should talk about it, reaching out to you, do the calls and do the other stuff. It's a heavy call early on. It's a very emotional, sensitive call, but that's the right thing to do. And same thing for the sponsor team. If on the sponsor team, start communicating the moment you get a feel out of it. And that's a part of the process because you're forecasting your business plan and you're forecasting the budget of the property. Once you forecast the budget, you should know where the cash should be in and out or not. And that's the communication that we owe to the LPs as we go. So, Trevor, thank you.